I think the Fed is trying to be almost painfully clear in their messaging. They need to slow down the pace of inflation. And in order to do that, they are going to need to be more aggressive, whether that is a prolonged experience with higher interest rates or whether that is, and I think there will be continued rate hikes past what we had previously expected. Both of those options are on the table, and equities need to adjust to the reality of higher rates and for longer. And that's what we're seeing here as stocks continue to soften up here on these messaging.
All right, so I want to ask you about the future being under pressure more specifically. I mean, Jay Powell said they're not making any decision until they see the data. We have two data points coming out, jobs report tomorrow, CPI next week. Why are the markets already under pressure when we don't actually know? Can we take him at his word, or are the markets doubting what he's saying and they believe that 50 basis point hike is going to happen no matter what?
Well, I think we need to take him at his word. I mean, throughout this entire process, starting really, almost 18 months ago, the Fed has been painfully clear in charting this path forward in a more aggressive manner. And they've really held true to that path early on, going with the 75 basis point moves, and then subsequently slowing as we've gotten further along. And the honest truth is we're closer to the end than the start. And that's why there's this hope every single time that there will be a Fed pivot. But Jay Powell ultimately has to re-intervene and re-emphasize the fact that inflation is first and foremost the primary focus for them. So he is being clear, and I think equities are continuing to look for the hope that we're going to get the pivot. But in reality, inflation is showing no signs of slowing down, particularly with how tight the labor market is, and that's really what's underpinning their decision here.
All right, so we're seeing the worst earnings season since all the way back in the great financial crisis. A lot of investors are turning their attention to bonds and the two-year note. Jeff Gundlach out yesterday saying he doesn't believe the top is in on that two-year note that's already crossed a 5% yield. What's your take on the investability? We're showing the quote right here. What does that take tell you about the investability of equities right now and the attractiveness of bonds?
Yeah. I mean, you're asking an equity guy whether we should buy equities. And the honest fact of the matter is, if I look out over the next couple of years, the economic backdrop is only going to really allow for an earnings or EPS growth of really low single digits. And I'm talking, 3 to 4%. That's a very difficult environment for equities to work. So that's your baseline. That's before we see multiples either expand or contract. So if you're looking at short-term rates at around 5%, against a profit growth backdrop that is equal to that or under that, I think the opportunity for bonds looks really good here. And it's not to say there's not areas in equities that work, and I think you need to be selective, and we would encourage investors to look more towards growth. But, take it on the surface, it's the time for interest rates or bonds to really shine here.
So, number one, I thought you said it was going to be like a shoe salesman shoe thing. You're actually bullish on bonds. So you kind of threw me off right there for a second. I do want to get back to equities. I want to get to your S&P 500 price target. Your price target's at 4050. We're just below 4,000 right now. So you're not seeing any growth when it comes to equities for the rest of the year?
Well, I think what we've experienced since October is a market that's run over 10%. Now, we've pulled back most really since the beginning of February. Our expectation was that was going to really carry us through the first half of the year, and we got that really in the first couple months. So I think the backdrop for profits remains impaired. I think the backdrop ultimately for equities to move higher is a difficult environment because it comes down to multiple expansion here. And to be honest, I mean, we're just having a conversation about whether the Fed's going to raise rates. Higher rates makes it more difficult for stock multiples to expand. The cost of capital goes up, and it's incrementally a negative for PE. So if you're not getting the profit growth, it's hard to see multiples expanding. The target is kind of really flat-ish from here.
All right, we're going to leave it on one last word. What sector do you see as the most attractive, at least for this last month of the first quarter, knowing that we're seeing the Fed meeting at the end of the month and possibly a rate hike of either 25 or 50 basis points?
Look, I think right now is an area for investors to continue to focus on secular growth sectors. I would say, I mean, you have it up there, technology. I mean, the truth of the matter is it's too early to get defensive because we don't see a recession on the horizon. And we're still a little gun shy on going full in on cyclicals. So I would encourage people to look at the secular growth areas of the market.